Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Welcome back to this income mini-series on the Australian Retirement Podcast. Today we're talking with Andrew Fraser from Merlon Capital Partners. And this is one of my favorite topics. We're talking about how you can use the share market to identify companies or shares that pay tax effective or even just regular income streams. What I like to look at when it comes to long-term investing is a long-term track record, and Merlon have just that. So you will find out all about the Merlon investment process in this episode with Andrew Fraser. If you have any questions and before you invest, I'd highly encourage you to reach out to a financial planner like James or Drew. And you can do that via the YouTube description. There are some links in there. Or if you're listening on audio, don't forget to use the show notes link that is available in your podcast player. I hope you enjoy this episode with Andrew Fraser of Merlon Capital Partners. Andrew, thank you for taking some time to join me on the podcast.
No problems, Owen. Thanks for having me.
It's great to chat. And it's always good to chat shares, income investing. We're going to talk a little bit of behavioural finance, which is an episode that we aired recently. When it comes to money, it's so important, not just in our personal finances and our retirement planning or things like that, but also in our investments as well. So you're going to tell us a little bit about that in today's show. Maybe just to go back in time to a bit of a younger version of yourself, can you tell us why Merlon, the business, was set up in 2010? Kind of what brought you and the team to it?
Yeah, I think it was clear for the founders that we all came from I guess corporatized funds management businesses that had multiple strategies, a lot of different things going on, probably very heavy on product and marketing, and less focused on investment philosophy and that sort of cultural aspects. So we decided in 2009 and opened up the business in 2010 to a boutique structure that really solely focused on investing and have that culture of investment excellence and focus, all aligned around a common philosophy. Was I guess the real driving force, and to that end, the business is 7 investment professionals only, with all other non-investment activities outsourced, so we can just focus on what we love doing. It's it's a passion for all of us, and we wanted to create an environment that was very much focused around that.
And you've been doing it for a long time now. Like for folks that aren't familiar, to be going for 14 years plus now, it's a big feat to continue to grow and to provide good results for your investors over that period of time. One of the things, like Andrew, I've been doing this for myself over 10 years, and interviewed hundreds, if not thousands, of different investors now, and it's been a really humbling experience. But it's not often that you come across an investment company that puts behavioral finance kind of front and center at what you do. A lot of different funds management businesses, you invest and they have a pretty good tagline on the website and these types of things, but this is really unique to me, and it's, I think, a really interesting point of discussion for us. So I'm curious, maybe there's like a why you decided to set it up the business with that focus, and then there's a how does it actually look in practice. So if you can walk us through that, I might have some follow-up questions, but I think this might be quite interesting.
Yeah, sure. So I guess every funds management has a stated philosophy that they believe. I think ours is articulated as you pointed out, probably differently to most other fund managers that tend to bucket themselves into a style of investing, whether it be value or growth, etc. For us, when we set up the business and thinking about surviving and providing excess returns to our investors was the why. Why do we think we can beat the market? Markets are relatively efficient. And also within Australian equities in particular, it's a hyper competitive environment. There's a lot of fund managers trying to beat the market. When we sat down, thinking about, I guess, why we believe we could outperform the market over time, it really centered on this concept of behavioural bias. And why do whilst the markets might be broadly efficient, is that there's still an opportunity to outperform, and why is that the case? And for us, it comes down to human behavioural biases. So things we as humans in all facets of life tend to do, and it's on common, I guess, well documented, human behaviors around fear and greed, not wanting to stand out from the crowd. So having unpopular opinions is not comfortable for most people, and also our recency bias, that we tend as humans to take short-term information, both good and bad, and we extrapolate it too far out into the future. So we spent a lot of time as a team trying to articulate that in a single sentence, and which was quite difficult. But it really comes down to that we believe these three tenets exist, and they will exist through time. Even we hear a lot about AI, index investing, and the like. Is that ultimately, whilst humans are still part of the ecosystem, is that we'll tend to be fearful when we should be greedy, and we'll be greedy when we should be fearful. And that we probably overplay our own ability to in our case forecast the future, or value businesses in a very finite, specific, single case scenario.
Mm-hmm. I like that. I think that a lot of investment companies or investors think that there are some commonly held edges or ways to improve the return of a portfolio, being an analytical advantage, an informational advantage. Like, for example, when people that are in the finance industry would get access to information or broker reports or company management that no one else could get, like that would give them an edge. But then there's this third one, which is the behavioral edge. And I think as professionals and people that study this a lot, you're uniquely set up to harness that and to capture some of that. There was I wanted to talk to you more specifically about your investment philosophy. And there was a quote that was on the website which I pulled, which goes, quote, "We believe people are motivated by short-term outcomes, overemphasize recent information, and are uncomfortable having popular views," end quote, which is exactly what you were just saying. Can you give us an example maybe of like where that investment philosophy might lead us to next? Because we're going to talk about the investment process, but what kind of things does that often unearth for you?
I guess the clear examples of that over the last little while, during COVID, for example, we had mass lockdowns. Global aviation was completely mothballed essentially, or
Mm,
put on ice for quite some time. So in that environment, the market and market participants, over extrapolated those short term scenarios. I mean, the reality is none of us knew how long lockdowns and the associated economic destruction or demand destruction would go on, or what government responses would be, whether it be fiscal, monetary, or and indeed health. So that's an example where investors have become overly fearful, and extrapolated the current circumstances too far out into the future. Whereas if you can take a long-term view, is that you can, in those scenarios, you can find some amazing opportunities. But again, that herd mentality at the time was the market was selling things like Qantas, for example, selling the casinos because the casinos were shut, and not recognizing that some of those businesses had some intrinsic hard assets backing those businesses, or indeed that ultimately there would be a medical response, and that the world would at some point get back to a pre-COVID
mm.
normality. And if you fast forward to today, is that taking a long-term view and selling, and not selling or investing in those businesses, has been exceptionally rewarding, albeit it's really uncomfortable at the time. And we all have a few more grey hairs than what we did beforehand off the back of it. But
Oh yeah.
that's the nature of investing, is that you can't generate a return without taking some degree of risk. But it's very
Yeah.
much about trying to go wide, eyes wide open. Have a diversified portfolio, because you're going to make mistakes. No fund manager, no investor gets 100% of their investment decisions right. So knowing that you are going to make mistakes, is key to building a portfolio that that works over time.
Mm. Um, Lucky to have grey hairs, I would say. I think I just lose mine instead, Andrew. So that's okay. Um, so one of the aspects that people who are maybe tuning in on the retirement podcast for the first time and hearing these investment conversations, one of the things that they would be illuminating to them is how an investment philosophy, so this belief that you have in the way investing can be done, then informs your day-to-day process and how you and your team actually go about finding these businesses, investing in them, and this kind of the research process, to put it in another way. And I've got there's this wonderful chart, this flow chart of sorts. It's like a funnel, and it shows the different steps in your fundamental research, so your company research as you go through, and then how things get into the portfolios. At what stage do you look back on the process and review previous things? Um, and I'm happy to be guided by you on just zooming in or out of the important points of this for the purposes of this conversation, because I can refer people back to the website and they can get in contact with the team as well if they're interested in investing for sure. But feel free to just walk us through that however you want to do that, Andrew. And feel free to use examples if you have them as we go through.
Yeah, sure. So I guess the first point is that if we're trying to exploit behavioural biases, the first thing we recognise is that we as investors and as humans are ultimately exposed to the same behavioural issues. So our process, and in fact, actually the business structure around how we operate and the accountability, is all based around trying to remove as much of that exposure we have to the behavioural biases that all investors face. So in order for us to invest on the basis of our investment philosophy, we need quite a strong, it's not rigid per se, but it's methodical in the way we operate things. If we think about, in terms of how we've structured the business, is that, we have quite a flat structure. So unlike, other funds management businesses where you have, a head of equities or a lead portfolio manager, senior portfolio managers, and, filtering down to junior analysts and so forth, is, we recognize that potentially can introduce behavioural bias, because the interactions between those individuals can influence how the portfolio may look, whether it be how people interact, trying to state the case for their investment ideas coming into the portfolio. So if you have a very introverted analyst, for example, is that they may not bang the table loud enough to get the portfolio manager to put their stocks in the portfolio, regardless of whether they're the best analyst in the team or not. Or it could be recency bias, where I as an analyst have had a tough 6 months or 12 months of performance, and essentially other members of the team have lost potentially some faith that I am a good investor. And it could be driven by a whole bunch of other macro factors that didn't suit me. So we've deliberately ensured that we don't have that kind of pyramid structure. Ultimately, Neil Margolis, our CEO and lead portfolio manager, has the final say. But we very much try to come to a consensus view around stocks that come into or out of the portfolio, and ultimately the analyst that is responsible for that company is responsible for that attribution, both good and bad. So again, we have a very accountable business structure when it comes to trying to remove, any behavioural bias creeping in. The next thing we do is we very much recognise that valuation is a range, and the range of valuation outcomes is much more instructive when you're trying to work out whether the market's become overly pessimistic or optimistic. So, and then I guess the other point is recognising that we're going to make mistakes, and valuation relies on a broad range of assumptions, and not all of them are going to come true. So you want to understand, if I'm wrong, what's the risk of permanent capital loss? What's a bear case or a low case scenario? And if we can identify that a stock is trading at or below its bear case, is that it's the first sign that actually the market's become overly pessimistic. And if that bear case is rock solid, and whatever the market's worried about actually gets, is factored into that valuation and plays out, and our view is wrong, is that the risk of permanent capital loss is diminished. And if you do this over a diversified portfolio, you're setting yourself up, in a much better framework to actually outperform the market through time. We also, religiously value companies on the basis of sustainable free cash flow, and I'm sure we'll get to some, questions on income and dividend streams, a little bit later on in the chat. But that's very important that we focus on a single way of valuing companies. We don't adopt a horses for courses approach, which again, if you allow analysts to choose how they value companies, is that behavioural bias can slowly creep in, because a stock that's done very well, and you mentioned JB Hi-Fi recently, previously, that's a stock we had in the portfolio. We bought that when the market was, very, very fearful. We've actually owned it a couple of times in the last 14 years. We owned it when the market was really worried. Initially, when they were really worried about Amazon entering the Australian market and what that meant for the future of, bricks and mortar retailers. And you probably recall from that time, there was headlines and examples in the States of, hundreds of retailers that, Amazon, basically pushed, out of existence because of a number of factors. And, we as humans went, well, that's what happened in America. That's going to happen in Australia, and JB Hi-Fi or Harvey Norman or Myer or DJ's will no longer exist. Now, all of those retailers have had their challenges, adapting to an ever-changing, consumer, environment. But JB Hi-Fi, if we fast forward, 8 years, has got, a more dominant market position. Myer still exists and DJ still exist, albeit they have suffered their own challenges through the way. So, we want to be buying companies when the market's overly fearful, and the bear case scenario is a good way of starting to identify that. On the flip side is, if you look at JB Hi-Fi's share price now, it's around, almost $90 a share.
Wow.
Back in 2016, it was it was sub $20 a share. So there's a dramatic change in the value of that, that business over that time frame. But you need to be disciplined. So you can't fall in love with these stocks, even though, we think JB Hi-Fi is, one of the best retailers in the world. It's got a great brand, a great business model, but you can't fall in love with these businesses. And if you allow analysts to choose how they value those companies or value companies individually, is what you find is that potentially stocks that have done well, you feel great about having in the portfolio. You go on, you meet clients and other investors, and they think that you're a genius for owning them. So if the earnings of that business haven't changed, the only way you can kind of keep it in the portfolio in our process would be to tweak the discount rate, so to make those cash flows more valuable than what you thought. Conversely, if there's a stock you don't want to own, and typically we're buying companies that are unloved. So Ramsay Healthcare is a stock that we've recently invested in, which is in the private hospital industry, and it's struggling at the moment for a number of factors. But it is the number one player. It's got a great portfolio of assets, and it's doing better than the rest of the industry. The industry is really struggling at the moment, but it doesn't feel good owning those stocks. So, if I'm the analyst for that company and everyone's telling me that, it's a terrible industry and those businesses are, going to go out of business, is that I might want to tweak my discount rate to get my valuation down to keep it out of the portfolio. So we don't allow analysts to do that. We want analysts to, essentially feel uncomfortable all the time by looking for the next idea, and being disciplined around, selling the stocks that have done well for us when they reach the upper end of their valuation range. And, the risk reward in that scenario changes demonstrably if you're in from when you initially invested around the bear case, where you've got, in our view, limited downside, but great upside, to very limited upside to more downside.
Mm. I don't know who coined the phrase, but they say that volatility is the price of admission. I feel like risk or uncertainty is the price of admission is probably the way I'd frame that. And I think if people are like, we get a lot of questions, particularly now, Australian Finance podcast, Andrew, which is more focused on beginners to intermediate investors. And we often get the question of like, well, why does the stock market do better than property? Why does it do better than cash? Why does it do better than basically everything else? And the answer that I often fall back on is that because you're paid to take that uncertainty, you're paid to wade into the waters when other people won't. And um, a lot of the reason for that is behavioral in nature. People are fearful. So therefore, you should look at it. But in our human nature, we're less inclined to do that. You're right when you said before about a focus on income. Um, this series that we're running is about helping people build a retirement portfolio that provides them with passive income because they've worked hard enough for long enough. Now they've got to switch that kind of dial over from active income to passive income and rely on their portfolio. When you go about picking companies at Merlin, do you actively target companies that have a high dividend yield? Like, is that something that you actively do? I know there's different strategies, but if you could talk a little bit about that, it'd be very helpful.
Yeah, so I guess the short answer is no, we don't target companies with superficially high, dividend yields, prospective or trailing. But our portfolios, through time, deliver more dividends and franking than investing in a passive ASX 200 fund.
Mm.
And the reason for that is when you invest in companies that are trading on, high levels of sustainable free cash flow, those companies also, through time, maybe not at right now, but through time as a portfolio, they deliver more income and more franking credits than the average company on the ASX 200. So it's actually an outcome of the way we invest. We have two portfolios. One is probably more targeted at your accumulators or retirees who are looking for more market risk. And then we have the Australian Share Income Fund, which is designed for those retirees or pre-retirees that are trying to replace their employment income with regular monthly income streams from their share portfolio. So one of the challenges for all investors, whether it be a fund manager or an individual, is yes, the dividend's important, but there's no point buying a company with a high dividend yield if the intrinsic value of that is above, the share price is above the intrinsic value, because you're just robbing Peter to pay Paul. It's great to get a dividend yield today, but if I have to sell those shares at a 30% loss in 3 years' time, all I've done is destroyed value. So when we're talking to our investors, that love the monthly distribution income that comes from the fund and the franking credits that come through each year, is that we do say to them, that income is just a component of total return, and it's always important to understand that.
It's really important to have that focus that you get income and growth. You don't want income and loss um, because you don't want the investment to fall in value. If you can otherwise help it, which is what you try and do, you try and tilt the odds to get that asymmetry to the upside, not the downside. There was just one little question I would like to tuck in here, which is I also noticed on the website and throughout your literature that you and the team have a pretty significant focus on ESG, and I was just hoping you could just it doesn't need to be a big thing, but I'm just hoping you can just explain to us how that's incorporated in what you do.
Yeah, sure. Well, when the market's fearful about a company, sometimes it is an S or a G, issue that is the reason why the market's, overly pessimistic. So, we factor those ESG issues into our valuation range. Um, you know, a good example of that, more on the G side of things, is companies making very poor capital allocation decisions. So they go and buy a business overseas, and ultimately sell that at a loss at some point. So we try and capture, if the market's worried that company A is going to go and do a very large scale acquisition, and regardless of they just want to get this deal done, is that we might actually adjust our low case valuation to take, in the example of APA Group several years ago, we basically said, look, what the company is communicating to us and to the market is that they want to do an acquisition. The sellers of assets know they want to buy those, buy anything at any cost. So, well, one way we can capture that is, rather than just not owning the stock, we can say, well, okay, what happens if they do what the market's worried about and spend $1 billion, and it's worth nothing at the end of the day? Well, let's lower the valuation by $1 billion, and how does that compare to the share price? And APA was one where actually we could invest in the stock, at or around our low case valuation, even taking into account that poor capital allocation cost shareholders $1 billion. So it is completely integrated, through our investment process in how we look at the valuation range, and also, I guess, carbon emissions, fossil fuel usage has been very topical for quite some time. So we'll look at, in the case of fossil fuel, whether it be a coal miner or an oil and gas producer, is we'll look at scenarios around decarbonisation and how that might change the valuation outcome. So whether coal comes out of the energy mix in 2030, 2040, 2050, what does that mean for the range of valuation outcomes? So we try to incorporate as much as we can into those, I guess, the range of valuation outcomes. And then another key tenet of our philosophy around ESG is actually actively engaging with portfolio companies around not only the investment issues but also the ESG issues. So when we make an investment in any company, we actually write a formal letter to the company board outlining who we are as Merlon, our investment philosophy, why we're invested in the company. So we state our valuation range to the company, and we outline what all the markets concerned. What is the market worried about? We communicate that to the board. We communicate what the ESG issues are that we think are pertinent to that company, and then we engage with the board to hopefully influence to the extent we can, but also to get more information back from the company around those issues and their thoughts on how they might address those concerns. And sometimes it may lead to us divesting and selling out of the company because our valuation range that we originally thought changes because that company has said, we're going to go and do an acquisition. So, we know that actually that low case scenario is more likely to be lower than what we originally anticipated, or ultimately, the company, comes back and says, look, we're not going to do that. And, we have more conviction in the investment itself.
It's interesting the way you articulate that around environmental, social, and governance issues, in that you actively adjust what the company's value is based on potential risks across governance in the case of the pipeline operator APA, or environmental issues or whatever that may come. And in reality, in theory, with mining companies, there's been plenty of examples like this in the last few years where they should have adjusted for like make good on the grounds and to restoration efforts, but they just don't do that. And so you as an investor in those companies actively make the decision to, well, we've got to offset for that potential liability, because if they are forced to do something, then that's part of the valuation. I like that approach rather than having it as a kind of just a checklist item or something like that, which some fund managers may be inclined to do, but incorporating it deeply into the process is really interesting. I've got two final questions for you, Andrew. One is you've mentioned Ramsey, which people will be familiar with from private hospitals and that type of thing. You've mentioned JB Hi-Fi as a very popular example. I still shop there regularly. I've got to admit, like I'm a prolific Amazon shopper. I will confess, but at the same time, I've been to JB probably you know 3 times in the past 2 months for things for our business or myself personally. Um, are there any other examples of businesses? We don't have to go too deep into them. I'm just to kind of help people understand the types of companies that you own or have owned in the past as a way to illustrate what you do.
Yeah, sure. Well, a couple of businesses that are be well known to your listeners that we have in the portfolio at the moment are the two major supermarket operators, Coles and
Mhm.
Woolworths, which have created or been the subject of a number of headlines and parliamentary inquiries,
Yes, they have.
which has created a degree of fear in the investment community around what may or may not happen. Um, and stepping back from, I guess, those issues is that the industry structure is very favourable to the two large players. They control around just over 2/3 of the grocery market. Yes, it has become more competitive with Amazon coming in, with Costco coming in, with Aldi rolling out across the country. But ultimately, the market share for those two businesses hasn't changed demonstrably over the last 10 or 15 years. So they've got a great industry structure behind them.
Mm,
They're reasonably well-run businesses. We don't believe that there is a lot of um, aggressive um, gouging. These are scale businesses, and given our geographic spread, our small population, is that it's not unreasonable to expect that prices here would be higher than in the
mm,
United States, for example, where there's much bigger population and competitive environment. Um, so again, factoring in a range of outcomes, whether it be loss of market share or margin decompression, if they've got to reinvest back into price to prove to the Australian consumer that they are doing their best for them, is that both those share prices appear to be trading in the lower end of the valuation range. And Woolworths historically being the market leader, generating higher growth than Coles, has always had I guess the market's always put a bit of a premium relative to the other players in the industry, but that's been eroded to an extent with the headlines, the change in CEO and so forth. But
mm.
we believe that ultimately both those businesses are in a great position on a medium term basis.
Mm. Oh, yeah, like you said, they've got some pretty wide moats around them. They've got strong competitive advantages for sure. So, I'll direct people to, I believe I pronounced it incorrectly, Merlon's website before. I said Merlin, rather than
So
Merlon.
all good.
But I'll put links in the podcast player or in the YouTube description for people to access and see for example, the investment process and the literature around how you deal with a lot of the issues around investment philosophy, the philosophy of the business and the team as well. And you can get in contact. Anyone that's watching this, you can get in contact with the team at Merlon via the website. My final question is more so around like the practical aspects of if I was a retiree or pre-retiree listening to this, how you see um, anyone that listens to this potentially using one of your strategies in their portfolios. And I will add the disclaimer that this show is hosted by qualified financial planners. So if you do need personalized financial advice, of course, seek out a financial planner. If you don't have one, you can find one on the Money Smart website or even use the link that's in our show notes. So with that disclaimer said, this is just purely just how maybe clients are using them already, but it might just be a useful way for people to be informed about how to approach a fund manager such as yourself.
Yeah, I mean, look, we see, across our client base, both funds used, in similar ways, albeit they are slightly different in terms of the risk profile, and the income fund obviously pays distributions monthly. But I guess at a high level, our portfolios are benchmark unaware. So we don't just start with the ASX 200, which 2/3 gets allocated largely to the top 20 companies, and within that, you've got 4 major banks, 3 iron ore miners, a couple of supermarkets. So it's quite a concentrated index. So we see people using our portfolios to offset their passive exposure. For individuals or advisors that have clients that have direct share portfolios, quite often those direct share portfolios, especially for retirees, will feature a lot of the the top 20 companies, and for a number of behavioural reasons and probably tax reasons, are unlikely to sell Commonwealth Bank, even if it's trading on a PE of 33 times and is the most expensive bank in the world. So we find that our portfolio complements those passive strategies and also the direct share portfolios. But also, I think just stepping back and thinking about the investment philosophy is, it's we see people using that, I guess, contrarian approach, for an allocation within the portfolio, because they know that there's not very many managers that are truly contrarian, investing in companies that that the market and participants don't like. And it's very hard as an individual investor to buy some of these companies when they are creating headlines for all the wrong reasons. So we see that that contrarian approach is useful to have an allocation if you believe that going against the herd is a way to outperform through time. But then also looking for a very different portfolio to whether it be other active fund managers or more passive strategies.
I like that idea of blending the strategies with existing portfolios, and any of the financial advisors that are watching this or listening to this can certainly appreciate that, because a lot of clients approach retirement for the first time. They go see a financial advisor. They've got a bit of CBA, a bit of BHP, and some of that and some of this, and for various reasons they do or don't want to sell, whether it's tax, whether it's behavioral reasons. And so it's about how do we adjust to that ongoing issue, let's say, or that ongoing holding in the portfolio without just making wholesale changes, which can be a mistake for the advisor, but also for the client or the end investor at the end of the day. So, Andrew, you've really given us a thorough overview of how you and the team at Merlon approach investing. I really, really enjoyed this conversation because it touched on those behavioral aspects and why that is so important. And a lot of people listening to this, or watching it, if you don't think that you have the knowledge or the temperament to do that type of investing, then you can outsource it to an expert who has the runs on the board and has been doing it for over 14 years. So, mate, this has been a great chat. Thanks for joining me.
No, thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.